Greetings viewers and welcome to today's info sharing session. We'll be covering the various depreciation methods which are available within the Sage 200 Evolution Fixed Assets module. Now, within the Fixed Assets module, we firstly have depreciation methods, which are then linked to asset types, and those asset types are then linked to individual assets, and based on the asset type, the depreciation is then calculated on the individual asset. Let's take a look at exactly which depreciation methods we can set up and make use of within the module. So firstly, under my fixed assets maintenance, I'm going to go to my depreciation methods option, and you'll see that we've got 7 depreciation methods that we can set up. These include straight line, equal allowance, reducing balance, units of usage, plant and machinery, immediate write-off, and zero depreciation. Let's just start with our straight line option. So the straight line option allows an equal depreciation amount to be depreciated per month until the asset has been fully depreciated. When setting up the straight line method, we can either specify a percentage or number of years. So I'm going to, in this case, use 25%, which equates to a 4-year depreciation period. We then have the equal allowance, which is very similar to the straight line. And in this instance, we would need to specify the number of years. So I'm going to use the 4-year depreciation method. We then have the reducing balance method, which calculates depreciation on the reducing book value in the subsequent years as the asset is being depreciated. And once again, we specify a percentage. We then have the units of usage method, which allows you to specify the number of units used of a particular asset within a certain period, and based on the number of units used, depreciation is then calculated. So a good example would be, for example, vehicles, where you want to depreciate an asset over the distance traveled in a particular period, and the depreciation would then be calculated based on the distance traveled within the period. Another good example would be, for example, maybe a photocopier. You'd want to depreciate the number of copies made, or print, the number of prints made, etc. So I'm going to specify the units of usage method. And in this particular method, we need to specify the total capacity that the asset can produce or consume within a certain period. So for example, if it's maybe a photocopy, we can say that the capacity is, for example, 10,000 copies. A vehicle could be the number of kilometers or distance traveled in a certain range within the vehicle, etc. Or a printer could be the number of prints made within a specific range. So in this instance, I specified that the capacity for that unit is 10,000 units. And we'll see later that we need to go and specify the actual units used, and then the system will calculate depreciation based on those units consumed within the particular period. We then have our plant and machinery. So the plant and machinery is a very flexible depreciation method, which allows you to set up depreciation percentages based on the number of years. So in this instance, I'm going to say that the plant and machinery period is 3 years, and I can then go into year and specify the percentage per year. So in this case, I'm going to say that in the first year, the asset will depreciate by 50%. In the second year, it's going to be 30%. In the third year, for example, 20%. And what you notice is that I need to ensure the depreciation percentages do add up to 100. So I'm just going to amend this and say that year 3, 20%. So in this instance, I'm saying for those asset types, they'll depreciate 50% in the first year, 30% in year 2, and 20% in year 3. So I can certainly be quite flexible with regards to the depreciation percentages based on the number of years for that particular depreciation method. We then have the immediate write-off method, where, as the name implies, the full value of the asset is written off in the first period when it begins depreciating. And finally, we have the 0% depreciation, whereby no depreciation occurs on the asset. So it could be a case that you know the asset isn't going to depreciate, but however, you want to keep the asset as a record on the asset register. So we've set up our various depreciation methods. And the next step would now be to go link asset types to those particular depreciation methods. Under fixed assets maintenance, I'm going to go to asset types, and I'm going to set up my asset types. And at this point, I now need to go link the asset type to depreciation method. So on the drop down for book depreciation, I'm going to go specify the option and link those two, and then continue. So I'm going to say link this type to equal allowance method. Link the reducing balance method. Link plant and machinery. We then have our immediate. And link our immediate method to that type. And we then have our zero type, which is going to be linked to our zero depreciation method. And finally, we're going to set up our units. So we have set up our depreciation methods and then linked the asset types to the depreciation methods. And now we can begin creating our fixed assets, which are then going to be linked to our asset type. So I'm going to add an asset, and I'm going to start with the straight line. Specify my straight line asset type, and specify purchase price, and then also specify the purchase date. And we can then note that we can also specify our book depreciation start date. And in this particular instance, I've specified that the book depreciation start date must be the same as the purchase date. So I've got my details there, and I'm going to continue. Next, I'm going to set up my equal allowance type. Our reducing balance. Right. Next, we're going to set up our plant and machinery. Immediate write-off. Followed by the zero depreciation asset. And then finally, we're going to set up our units of usage asset. Right, so we've got our various asset types then. And if you just go add one of the assets, you'll see that we've got our asset information there. We specified our asset type, which has been linked to our depreciation method. We specified our purchase price, our purchase date, and under the depreciation tab, we can specify the start date for when the asset is going to begin depreciating. And now we can then move over to our reports and see exactly how depreciation is calculated based on the various depreciation methods. Under reports, I'm going to go to depreciation reports and go to book depreciation. And let's just start with our straight line asset. Right, so I'm going to run the report as at the first month when the assets begin depreciating. And if I preview that, see we've got our purchase price, our purchase date, depreciation start date, and then we've got details about the depreciation. So the total depreciation, prior year's depreciation if applicable, current year and current period, and then we've got our book value, which is the purchase price less the depreciation value, going to give us our book value. Right, so we can then move on and we can then go and view the report. So I'm just going to go and run the report now for the subsequent month. And if I preview that, you'll see we now have our total depreciation, which is current year, and that being for the 2 months. And you've got our current period, which is being for the month. and the depreciation report is being run, and we then have our book value available. Right. And we would then go and run the report as at, for example, the end of the year, which would then give us the value. And in this particular instance, it's a 4-year depreciation process, or 4-year depreciation for the asset. And we've now depreciated 25% of the asset in the first year, and we then have our book value available. If we then move over to our equal allowance, which is very similar to the straight line method, okay, just go run the report for January. And if I preview that, you'll see that once again, you've got the value, the asset information, and then details of depreciation. And if I run the report for the following month, we've then got the same value. So it's an equal depreciation or fixed depreciation amount being calculated each month until the asset is fully depreciated. We then move over to our, let's move over firstly to our plant and machinery. Now remember is that the plant and machinery setup is set up to a 3-year depreciation period, being 50% in year 1, 30% in year 2, and 20% in year 3. I'm going to run the report for the first period, and if I preview that, you'll see that we've got our first period, and I'm going to go run the report as at the end of the first year, and just go see the depreciation calculation there. And so as you can see there, the purchase price was 30,000, and based on 50% depreciation, the book value is now 15,000. If I then go run the report the following year, we can then see that there's been a further 30% depreciation being calculated in year 3, I beg your pardon, in year 2, and then finally, in the final year, in year 3, we're going to have the 20% being calculated based on the 3 years of the depreciation for that particular asset type. Right, let us go on to our immediate write-off. And so, as the name implies, the system is going to write off the full value of the asset in the first period. So I'm just going to go back to the first period, which is when the asset began depreciating. And if I preview that, you'll see that we've got our purchase price there, and the full value has been written off in the first period, leaving us with a book value of 0. So if we then run a report for the following period, no depreciation, as the full value has been written off in the first period when the asset began depreciating. Let's look at our 0 depreciation method now, and just go and set up those details. That's 0. So once again, no depreciation being calculated. We've got our purchase price, revalued value, and then the book value with no depreciation being calculated, as it's a 0% depreciation asset type. But let's move on now to our reducing balance method. And I'm going to go run the report for the first period. So we've got our value there, our purchase price information, and we've got the depreciation for the first period, so in our book value. Now, I'm going to go run the report at the end of the first year, and we can see what the book value is going to be after 12-month period. And we have now book value. So reducing balance comes into play in the second year, where the system is going to look at the book value and use this figure to calculate depreciation for the second year. So 18,000 is currently the book value. I'm now going to go run the depreciation as at the end of the second year. And you see that the figures are now different simply because the system has taken the book value at the end of the first year and used that as a basis to calculate depreciation for that year. If I then move on, for example, to just checked or confirm that the book value is 13,500. And if I then move over to the following year, and preview that, you'll see that the depreciation has now been calculated on the closing balance at the end of the previous financial year. And the system will then use the book value to calculate depreciation going forward until the asset has fully depreciated. Right, and then finally, we have our units of usage. Now, asset types linked to, or assets linked to the asset type units of usage work slightly differently. And you would then need to go and specify the actual number of units consumed for the asset within a specific period in order for depreciation to be calculated. Under my fixed assets transactions, I'm going to go to asset transactions, locate the asset, which is, so if I highlight the units of usage asset, you'll notice is that the units usage tab becomes available. And if I select it, I now need to specify the number of units that were used for that asset during the period. So it tells me that there's my purchase price and the capacity of units for that particular asset. And I'm now going to simply specify the period that I want to insert the details or the number of units consumed for the asset. So make it the end of the month. And I'm going to say and I'm now going to specify the number. So this could be, for example, the number or the distance traveled of any vehicle, the number of prints made on a printer, the number of photocopies made, etc. So I'm going to say, for example, that in this instance, there were 1,000 copies made, and this applies to both options. And I'm now going to say okay to that. Back to my depreciation reports, book depreciation, and I'm going to look at the units of usage for the period where I've captured that information, and just go specify the date range. And if I say preview, we then have the purchase price. And as you can see is that we've now got the current period, current year, and the information there would obviously be based on the number of units consumed for the asset. So it's done a calculation based on the total capacity of the asset, the number of units that were consumed for that period, and calculated our depreciation. If I then go and I back to my asset transactions, and I then go back to units of usage, I'm now going to, for example, say that in the following period or the next month, we're then going to capture the actual usage, which would be February, and I'm going to go specify the information. So, for example, in this case, there were maybe 500 units consumed and applicable to both options. And you'll notice is that it does keep a record of exactly, for example, in this case, at a certain point in time, the number of units that have been previously consumed or entered for that particular asset. So, okay there. And if I go back to my reports, I'm going to go to units of usage. And I'm just going to change our date now to reflect the second month. And preview that. And as you can see, it's now given us current period being 500, the current year being the first 2 months, and we've then got our book value, which is based on depreciation value up to the point in time. So the units of usage method allows you to depreciate on the number of units consumed of the asset within a certain period. So if we then just go back to our depreciation methods, and we've got our methods there, straight line is really just a process whereby a fixed amount is being depreciated on the asset per period until the asset is fully depreciated. Equal allowance is very similar to straight line. A reducing balance really just takes the balance as at the end of the first year of depreciating and then uses that particular book value to depreciate in the second year, etc. In subsequent years, it uses the closing balance at the end of the particular period. Our units of usage, as mentioned, is that it allows you to specify the capacity of an asset in different units, and then each month you would then go specify the actual units consumed based on that information. The system then calculate depreciation based on the number of units used. The plant and machinery is a very flexible method as it allows you to specify a number of years, and then within those particular years specify a percentage depreciation based on the number of years for that particular asset type. Immediate write-off, as the name implies, writes off the full value of the asset in the first period of depreciation, and then 0% depreciation means is that the asset is not going to depreciate. However, you may want to keep the asset on the register just for tracking and record purposes. So you can obviously do that and then not have the asset depreciate. So as you can see, variety of depreciation that can be used, which are then linked to asset types. Those asset types linked to individual assets, and based on information, the depreciation is calculated based on the asset setup, on the asset type setup. I do hope you've enjoyed this presentation. Thank you for tuning in. It's over and out for me, and goodbye.